Bismillahirrahmanirrahim. This is the first video on accounting quality. And in this video, we will discuss the relevance of fair representation of performance for the reporting period and why it should provide relevant information to forecast expected future earnings. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. A firm must present a fair performance for the reporting period, as this is important because its earnings include substantial one time gain and that represents a poor earning quality, as such gains may not be replicated in the future. At the same time, there may be one time losses that will impact the current earnings negatively. However, such losses are not indicative of future earnings of the firm. So the analyst must exclude these items to present a better quality of accounting report. Let us talk about these non recurring gains first of all. So, non recurring gains refer to one time or infrequent gains that are not expected to recur regularly in the future. These gains can significantly impact a company's reported earnings for a specific period. For example, gain on sale of assets. A company sells an equipment or piece of property at a price significantly higher than its book value, resulting in a gain on the sale. This gain is considered non recurring because it does not reflect the company's ongoing operational profitability. Another example is legal settlements or awards. A company receives a settlement or legal award that results in a gain. This could be from winning a lawsuit, receiving compensation, or settling a legal dispute favorably. Such gains are typically non recurring as they are not related to the company's core business operations. Yet another example is insurance reimbursements. Now, if a company receives an insurance payout that exceeds the actual losses incurred, like insurance reimbursements due to a natural disaster or accident, the excess amount received would be considered a non recurring gain. Then, reversal of write downs or provisions, like if a company reserves or reverses a previous write down of assets or a provision for liabilities because the conditions that led to the write down or provision are no longer present, any resulting gain would be non recurring. Another example is currency exchange gains. For multinational companies, gains from favorable currency exchange rate movements can sometimes be substantial. These gains are non recurring unless the company operates in a volatile currency environment where such gains are frequent and predictable. Yet another example is income from discontinued operations. So, income generated from discontinued operations, such as the sale of subsidiary or a segment of the business, is considered non recurring because it relates to activities that are not part of the company's ongoing operations. Finally, tax benefits from carry forwards. Occasionally, companies may recognize non recurring gains from the realization of tax benefits, such as the utilization of the tax loss carry forwards or tax credits which were previously unrecognized. These are some of the examples that illustrate how non recurring gains can arise from various events or transactions that are not expected to happen regularly or contribute to the company's sustainable earnings. It is important for investors and analysts to identify and understand these items when evaluating a company's financial performance and assessing its earning quality. Yet another non-recurring gain may be related to distortion of financial performance. Distortion of financial performance refers to situations where the reported financial results of a company may not accurately reflect its underlying operational performance or true financial health. For example, non recurring items we have just now talked about, non recurring gains or expenses can distort financial performance. Accounting manipulations. Sometimes companies may engage in accounting practices that manipulate financial results. This could include aggressive revenue recognition, improper expense capitalization, or altering depreciation schedules to smooth earnings or meet targets artificially. Such practices distort the true financial position and performance of the company. Then, changes in accounting policies, especially if not properly disclosed or explained, can distort financial performance. For example, switching from one method of revenue recognition to another can lead to sudden changes in reported revenues and profit figures, making year over year comparisons misleading. Then seasonal variations. Some industries experience seasonal fluctuations in revenue and expenses. If these variations are not adequate or not adequately explained or normalized in financial reporting, they can distort the perceived financial performance of the company. For instance, a retail company might show higher sales and profits in the holiday season compared to other quarters, which might not be sustainable throughout the year. Then merger and acquisitions impact. When companies undergoes merger or acquisitions, the financial results can be distorted due to one-time integration costs, restructuring expenses, or changes in revenue recognition policies. These factors can temporarily affect reported earnings and mask the underlying performance of the merged entity. Then, use of pro forma earnings. Companies sometimes report pro forma earnings which exclude certain expenses or include non recurring gains to prevent a more favorable picture of financial performance. While pro forma earnings can provide insights into ongoing operations, they can also distort the true financial performance if not used transparently or excessively. So, these examples illustrate how various factors can distort the financial performance of a company, making it crucial for investors and analysts to carefully scrutinize financial statements and understand the underlying reasons behind reported figures. Then another reason may be difficulty in forecasting. This arises when future financial performance of a company becomes uncertain due to certain reasons or various factors. So, some of these may be economic uncertainty. Economic downturns or recessions can significantly impact consumer spending, demand for goods and services, and overall market conditions. For example, during an economic recession, consumer discretionary spending may decline, making it difficult to forecast sales and revenue growth for companies in sectors like retail, hospitality, or luxury goods. Then, industry disruption, technological advancements or regulatory changes can disrupt the entire industry. For instance, the shift from traditional fossil fuels to renewable energy sources can disrupt the energy sector, making it challenging to forecast future earnings for companies heavily invested in fossil fuels. Then competitive dynamics, that is changes in competitive landscape such as new entrants, mergers and acquisitions, or pricing strategies of competitors can impact market share and profitability of companies. This uncertainty makes it difficult to predict future revenues and earnings growth accurately. Then currency volatility, we have already talked about. For multinational companies, fluctuations in exchange rates can impact revenue and expenses. So when translating foreign currency transactions into the reporting currency. Now this currency volatility introduces uncertainty in forecasting future earnings, especially if currency movements are unpredictable. Then, supply chain disruptions, events like natural disasters, geopolitical tensions, or pandemics, as seen with COVID 19, can disrupt global supply chains. These disruptions can lead to shortages of raw materials, delayed production schedules, increased cost, and lower sales volumes, making it challenging to forecast future financial performance. Then regulatory changes. There's changes in government regulations or tax laws can impact cost, pricing strategies, and overall profitability of companies across various industries. Uncertainty around regulatory changes complicates forecasting future earnings and future and financial outcomes. Then internal challenges, company specific factors such as management changes, operational inefficiencies, unexpected lawsuits, or unexpected capital expenditures can create uncertainty about future financial performance. These internal changes can affect profitability and cash flow projections. Finally, seasonal variations. Industries with significant seasonal variations in demand, such as retail, agriculture, or tourism, face challenges in forecasting due to fluctuating sales patterns throughout the year. Predicting peak and off peak periods accurately is crucial for revenue and earnings projections. These examples demonstrate the diverse factors that contribute to the difficulty in forecasting future financial performance of companies. Analysts and investors must consider these uncertainties and risks when making investment decisions and assessing the long term viability of companies. Then, impact on valuation. This can vary significantly based on different factors and context, like technology startups. A startup that demonstrates rapid user growth, example, monthly active users, can see its valuation increase due to the potential for monetization and network effects. Technology innovations, companies with groundbreaking technology or intellectual property often command higher valuation due to their competitive advantage and future revenue potential. Then, public companies, quarterly earnings that exceed market expectations can lead to a rise in a company's stock price and market capitalization. Successful mergers, acquisitions, or partnerships can positively impact the company's valuation by expanding market reach or reducing cost. Then, real estate, properties in prime locations or areas experiencing significant development can see their valuations rise faster than those in stagnant or declining markets. Development or infrastructure projects nearby can positively impact property valuations by improving amenities and accessibility. Then private equity and venture capital, the potential of for a lucrative exit such as an initial public offering or acquisition by a larger company can increase the valuation of a portfolio company. Private equity firms that successfully implement operational efficiencies or strategic initiatives in their portfolio companies can enhance their valuations. Then commodities and natural resources, that is fluctuation in global supply and demand can significantly impact the valuation of commodities such as oil, gold, or agricultural products. Even political stability or instability in regions that produce commodities can influence their valuation due to potential disruptions in supply chains. Then art and collectibles, changing tastes among collectors or growing interest in specific artists or genres can lead to increased valuations for artworks and collectibles. High profile auctions, sales that exceed previous records can set new benchmarks and drive up valuation for similar pieces. Then cryptocurrencies and digital assets. Speculative interest and investor sentiment can cause significant fluctuations in cryptocurrency valuations, often driven by news, events, or regulatory developments. New developments in blockchain technology or enhancements to digital asset can increase their utility and perceived value, affecting their valuation. So these examples illustrate how diverse factors such as market conditions, technological advancements, financial performance, and external influences can impact the valuation of different assets and entities. Yet another reason is transparency and trust. These are the crucial elements in various contexts, influencing perceptions, relationships, and outcomes. For example, corporate governance. Companies that provide clear and accurate financial statements build trust with investors and stakeholders, enhancing transparency. Transparent processes for board appointments and governance practices demonstrate commitment to fairness and meritocracy, fostering trust among shareholders. Then, government and politics. Governments that publish budgets, policy decisions, and performance data openly promote transparency, which can increase public trust and engagement. Transparent electoral processes, including voter registration, polling, and ballot counting, are essential for ensuring trust in democratic systems. Non-profit organizations that disclose financial information, program outcomes, and use of funds build credibility with donors, fostering trust and encouraging ongoing support. Transparent reporting on the impact of programs and initiatives demonstrates accountability and help stakeholders understand the organization's effectiveness. Then media and journalism. Media outlets that adhere to journalistic principles of accuracy, fairness, and impartiality earn trust by providing transparent reporting of facts and events. Transparent practices regarding the sources of information used in reporting help maintain credibility and trustworthiness. Then, tech companies that implement transparent policies and practices regarding data collection, storage, and usage build trust with users concerned about privacy, providing visibility into how algorithms works and their impact on users' experiences can enhance trust in digital platforms. Then clinical trials and research, transparent reporting of clinical trial results and research findings is critical for building trust in the efficacy and safety of medical treatments and pharmaceutical products. Healthcare providers that prioritize patient data security and transparent communication about data handling practices strengthen patient trust in the healthcare system. Then educational institutions that maintain transparency in admissions processes, academic standards, and faculty qualifications enhance trust among students, parents, and stakeholders. Transparent policies regarding tuition cost, financial aid availability, and scholarship opportunities help prospective students and their families make informed decisions. In each of these examples, transparency involves clear communication, openness, and accountability, which are essential for establishing and maintaining trust among stakeholders, whether they are investors, citizens, donors, users, patients, students, or the general public. So, in conclusion, earnings quality is crucial for investors seeking to assess the long term viability and performance of a company. A firm that relies on substantial one time gains from activities unrelated to its core operations demonstrates poor earnings quality because these gains do not reflect sustainable profitability or the company's ability to generate consistent earnings in the future. In the context of earnings quality, for example, a firm reporting a large expense from a warehouse fire that was not covered by insurance highlights another aspect of how non recurring or unusual items can impact financial reporting. So, let us look into some of the related examples in this regard. So, non recurring expenses are the costs that are not expected to happen regularly and are typically one time events or infrequent occurrences. For example, legal settlements, expenses related to settling a lawsuit or legal claims, assets write offs, that is, cost associated with the impairment or write off of a company's asset, severance payments, payments made to employees as part of a layoff or termination package, restructuring costs, expenses incurred from reorganizing a company's structure, such as layoffs or office relocations, major repairs or upgrades, large scale repairs or capital improvements that are not part of routine maintenance, acquisition cost, that is, expenses related to acquiring another company or business, including due diligence and legal fees, one time consulting fees, fees paid for consulting services that are not expected to be needed regularly, disaster recovery cost, expenses incurred due to a natural disaster or unforeseen event affecting business operations, penalty payments, costs resulting from regulatory fines or penalties, special event cost, expenses related to a unique or special event such as a large scale promotional campaign or major company anniversary celebrations. So these expenses are generally considered outside the normal operating activities of a business and can significantly impact financial statements in the periods they occur. Then, impact of reported earnings. Non recurring expenses can significantly affect reported earnings as well, often making financial performance appear worse in the short term. So, some of the examples may be legal settlements, we have just now talked about. A company may settle a major lawsuit, and the impact will be that this expense will reduce net income in the period when the settlement is paid. Although it doesn't reflect ongoing operational performance, it can make companies' earnings look worse for the period. Similarly, assets write off, a company writes off obsolete inventory, and the impact will be that this write off will decrease the company's reported earnings for the period, reflecting a loss that does not arise from regular business activities. Severance payments, for example, a company pays in severance to lay off employees, and the impact will be that the severance payments reduce net income. But since these are not regular expenses, they can distort the true operational profitability of the company. Restructuring cost, for example, a company incurs cost to restructure its operations. The impact is that these costs reduce earnings for the period in which they are recorded, but they are not part of the company's ongoing operational cost and thus do not reflect normal operational performance. Then, major repairs or upgrades. For example, a manufacturing facility undergoes a renovation. So, the impact is that the expense reduces net income for the period. This is a significant one time cost that doesn't impact the company's usual operations. Acquisition cost, for example, cost related to acquiring a new company. The impact is that these costs lead to a significant drop in reported earnings, even though they may contribute to future growth or efficiencies. One time consulting fees, for example, a company spends on consulting services for a strategic overhaul. The impact will be that these expenses will reduce reported earnings for the period but does not reflect the regular business operations. Disaster recovery cost. For example, a company incurs expenses to recover from a natural disaster. The impact will be that these costs will decrease net income for the period but are not reflective of the company's typical financial health. Then penalty payments. For example, a company pays a fine for regulatory non-compliance. The impact will be that this penalty reduces earnings but is considered a non-recurring expense that is not part of routine business operations. Then special event cost. For example, a company spends on a one-time promotional event. The impact will be that the expenses impact earnings for the period but doesn't reflect the ongoing cost structure for the business. So non-recurring expenses can significantly lower profit margins in the period they occur, potentially misleading stakeholders about the company's true operational performance. Analysts often adjust reporting earnings by excluding non recurring expenses to better understand the company's core profitability. Example, earning before interest and taxes, um, or adjusted earnings, etc. Overall, while non recurring expenses can provide important information about special events or decisions, they need to be considered carefully when assessing a company's financial health and performance. Other reasons may be difficulty in comparability. Investors and analysts rely on consistent and comparable financial statements to evaluate a company's performance over time. Non recurring expenses, like the one from the warehouse fire, make it difficult to compare current earnings with past performance or to forecast future earnings accurately. Then, mitigation through disclosure, like high quality disclosure practices, can mitigate the impact of non recurring items on earning quality. If the company clearly labels the expenses related to the fire as a one time event and provides sufficient detail about its non operational nature, analysts can adjust their assessments accordingly. This transparency helps investors understand that the reported earnings are temporarily affected and may not reflect the company's true ongoing profitability. Analysts often perform adjustments to earnings to exclude non recurring items when assessing the underlying earnings power of a company. If the non recurring nature of the warehouse fire expense is well disclosed and understood, analysts can exclude these items from their analysis to get a clearer picture of the company's normalized earnings. Then, finally, overall impact on earnings quality. So, while the reported earnings for the period affected by the warehouse fire may be temporarily lower, earning quality can remain high if the company effectively communicates the non recurring nature of such business expenses. So, this ensures that investors can make informed decisions based on a more accurate understanding of the company's sustainable earnings potential. So, in conclusion, earnings quality is enhanced when companies disclose and label non recurring items appropriately. While certain events like a warehouse fire can lead to unduly low reported earnings for a specific period, transparency and disclosure help maintain trust and clarity in financial reporting, ultimately supporting higher earnings quality over a long term. So, this completes the first video on accounting quality. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.